Hello, good morning to all. Welcome to this week, brand new week of markets, daily dose of market insights. So the year passes pretty fast. So right now we are almost 3 weeks before 2023 ends. So very good morning to all. Today will be Monday, 11th of December. So before we start our daily dose of market insights, let's take a look at the disclaimer slides first. Okay, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposit. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. Okay, give me a minute. I think my screen seems to be freezing at this point in time. Let me share again. Okay, give me a minute. A couple of seconds here. Okay, so this is the disclaimer. So let me repeat the disclaimer again. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. And as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so usually before we start our short-term technical outlook, let's recap on what happened on last Friday and even during the past 2 weekends on Saturday and Sunday. So on last Friday, what we see over here is that there's actually one key economic data release, which is the US non-farm payroll data. So the US non-farm payroll data actually came in better than expected. So market is expecting only 180K jobs added for the month of November, but however, it actually surpassed the expectation slightly and came in at 199K jobs added. So let me share with you all the details of this number in terms of the economic data over here. So what we could see over here is at this point in time, this is the non-farm payroll data. Okay, so what you could see over here is 109K added versus 150K in the previous month and above 180K of the consensus. So if you look at the trend of the non-farm payroll data, it's still weak over here at this point in time. It's still a slightly weak, still below the 12-month moving average, about 250K added. So all in all, right, yes, the job numbers is actually on the softer side, but it's not as feared by the market participants. And also on the other hand, the unemployment rate has managed to come in better than expected as well, which is 3.7% for November, much more lower than the previous month of 3.9% and consensus view of 3.9% as well. So overall, what I could see over here is that the US job data at this point in time is not indicating that the US economy is on the trajectory of a potential hard landing in 2024. So that soft landing view still pretty much intact. So that actually explain the desynchronization of the market across the board on last Friday. So what we could see over here is that stronger job data, there is a lesser need for the US Federal Reserve to cut as aggressively in 2024, which markets actually pencil in at least 4 cuts in 2024 with a total of 100 basis point. All right, but given this soft landing nature as depicted by the US job market, they may not be necessary to cut as much. So that actually explains the strengthening of the US dollar on last Friday, and also in line with the US 10-year Treasury yield ticking up as well, right at the 200-day moving average. All in all, why the stock market actually continue to actually perform fairly well on last Friday, all the US benchmark indices ended the session in the green. the S&P plus 0.4%, the Nasdaq plus 0.39%, the Dow Jones 0.36%, the Russell 2000 plus 0.67%, and also the Nasdaq 100 and the S&P 100, S&P 500, pardon me, managed to actually cap off the week with 6 consecutive weekly gains. All right, so that is pretty much of a fit so far. So pretty much of a fit right now, of a bullish fit. So what we could see over here is that markets are still anticipating of a Santa Claus rally. Why? Because of this seasonal, typical seasonal positive performance in the month of November and December in the past 20 years or so. So later I'll share with you on the short-term technical outlook on the benchmark stock indices. All right. So another news that I'll share with you all will be the release of China economic data on Saturday. So over here is that on Saturday, the inflation numbers in China came in worse than expected. It plunges to negative territory, negative 0.5% year on year, but much more worse than consensus expectation of negative 0.1% and below the previous month of October, negative 0.2%. So if you look at the trend of consumer inflation in China, we are still not escaping the path of deflationary risk spiral in China. So that actually explains why the lackluster movement of the China stock market and its proxy, the Hang Seng indices, why they actually underperform the rest of the world major stock indices, despite the fact that in the last 1 month or so, I would say the last 2 months or so, where we see a broadening trend of the weaker dollar and a lower global longer term 10-year sovereign bond yields. So overall, the China stock market and the Hong Kong stock indices is not benefiting for a weaker dollar due to the fact of this inherent persistent structure weakness in the China economy, which is i.e. as being explained by this ongoing deflationary fear risk that is still intact in China, as pretty much evident by the latest CPI data out from China over the weekend, where it plunges close to a 3-month low at negative 0.5% year on year. All right, so now back to the short-term technical outlook. So let's start with the FX market first. So if you look at the FX market over here, let me share the trend of the FX market. One second, where is the trend? Yes, this is the trend. Okay, so now let me expand my screen so that you all could see much clearer. Okay, so this is the trend of the FX market based on a rolling 5-day performance. So what we could see over here is that the dollar actually strengthened on last Friday on the bit of this much more upbeat, better than expected US non-farm payroll data. The dollar yen strengthened, but however the rest of the dollar pair didn't actually strengthen as much as the dollar yen. It kind of trading sideways in the rolling 5-day performance. So what we could see over here is that yes, we may see dollar strength come back on last Friday, but it does not start to have a much more persistent strength at this point in time. So if you stretch it up longer in a 1 month rolling performance, so last time was the 5 days, so now right now is the 1 month rolling performance. So if you look at the 1 month rolling performance, all the dollar pair is actually still trading below at the start of the month, the start of the rolling 1 month period that is being tracked by this performance chart. So all in all, yes, a bit of dollar strength coming back, but it still came in, still has not, we call it, totally erase the previous month of losses at this point in time. So now what will be the short-term technical outlook on the major FX pair? So very interestingly, let us start with the European pair first. So still recall that on late last week we flipped to a bullish bias on the euro dollar because it's coming very close to the 0.7 pivotal support level. So that's our short-term pivotal support level we have on last Friday, also confluencing with the upward sloping 50-day moving average, indicating to us that the medium-term trend still remains intact on the bullish side of the story. And also on the hourly RSI, hourly RSI also managed to start to slope upwards as well after hitting the overbought region earlier on the previous Friday on the 1st of December, and right now it's going to actually inch back up above the 50 level. So indicating to us that this minor downtrend or minor movement that from 29th of November all the way down to last Friday's swing low, the momentum is not actually showing much potential strength to potentially push prices much lower, holding at that 0.7 short-term pivotal support. So still no change, still maintain a short-term bullish outlook on the euro dollar as long as 0.7 short-term pivotal support holds. But however, it got to have a break up above 0.82. So 0.82 considered as the upside trigger level for today. We saw confluence with last Friday high, right ahead before of the non-farm payroll data release, and as well as confluence with the longer term 20-day moving average, also 200-day moving average, pardon me, that also acting as a resistance at 1.082. So a breakout above 1.082 will kind of reinforce this potential short-term recovery scenario to test the next intermediate resistance at 1.09. But however, if we start to see a hourly close or breakdown and a breakdown below 1.07 short-term pivotal support level, then this short-term recovery scenario will be invalidated to see the extension of this minor corrective decline heading down towards potentially the next support level at 1.063/1.06 figure level. That's for the euro dollar. So now heading on next will be the sterling pound. So the sterling dollar going to actually flirt with the 20-day moving average at this point in time. So on last Friday, yes, prices managed to push down, but managed to help right at the short-term pivotal support level that we mentioned earlier, 1.25 figure level, and also confluence slightly above the 200-day moving average as well. So as long as 1.25 short-term pivotal support holds, we will still maintain our short-term bullish outlook recovery scenario on the euro, on the sterling dollar, and also taking a look at the RSI. The RSI also has started to shape a higher low, whilst price action trades out a lower low on last Friday, ex-post non-farm payroll release. All right. So all in all, this is what I call a bullish divergence condition, as being flashed out by the hourly RSI indicator, indicating to us that this minor decline downside momentum that is in place since 4th of December high all the way to last Friday low, the momentum is losing strength. That means, i.e., it increases the odds of at least a potential short-term recovery. First resistance level to watch, 1.2610. Above 1.2610 potentially may retest the minor range resistance in place since 29th of November at 1.2730. But however, a breakdown below 1.25 figure level invalidates this short-term recovery scenario to see a test at this medium-term support level of 1.2430, which confluence with the medium-term ascending trend line support that I draw over here in place since 1st of November swing high. Swing low, pardon me, 1st of November swing low. Okay, so still maintaining that short-term bullish outlook on the sterling dollar as long as 125 figure levels holds. Now, moving on next, what's cooking on the dollar yen? So for the dollar yen, if we recall that last Friday, we flipped to a short-term bullish bias in and to look out for a potential counter trend rally. Why? Because on last Friday, I explained that several short-term indicators has reached overstretched condition on the downside, and potentially the dollar yen could be ripe for a potential short-term counter trend rebound, which it indeed took shape on last Friday, upon the reinforced by the better than expected non-farm payroll data. So the resistance that we highlighted on last Friday is 144.80/145.30, and there's this 146.30/146.70. So the resistance level has already been met already at this on last Friday. So right now it's fast approaching to this resistance zone at 146.70 level, which is also pretty much key. Why? So if you look at 146.70, why is it key? It also confluence with the pullback resistance of this former medium-term ascending channel support broken down on last Thursday now turns into a pullback resistance, as well as the minor congestion area from 29th of November to 5th of December as seen on the hourly chart over here. So with that, and with the hourly RSI also coming very close to the overbought region, we will be flipping to a bearish bias again on the dollar yen, as long as 146.70 short-term pivotal resistance that I set for today is not surpassed to the upside. First near-term support to look out for will be 144.20 on the dollar yen. So if we start to see a breakdown below 144.20, then potentially it could increase the chances to retest last Thursday's swing low area, and as well as the key 200-day moving average that is acting as a support level or support zone at 142.20/14160. But however, if we start to see an hourly close above 14670, then this short-term bearish outlook on the dollar yen will be invalidated to see the continuation of this extension of this minor counter trend rebound heading towards potentially the next intermediate resistance at 14670, further out 14860, which confluence with the downward sloping 20-day moving average, and as well as the minor swing high area of 28th of November and 30th of November, also confluencing at 14860 level. Okay, so that's the outlook for the short-term outlook on the dollar yen, flipping to a short-term bearish bias as long as 14670 key short-term pivotal resistance is not surpassed for today. Now, Aussie dollar. So Aussie dollar going to trade sideways on last Friday after playing around with the 200-day and the 20-day moving average, but still holding above the 65.20 short-term pivotal support that we have on last Friday. So given that this support level still continues to hold, we will still maintain that short-term bullish outlook on the Aussie dollar. But however, it got to break up above 66.20 to reinforce this short-term bullish outlook. So what 66.20 is in fact last Friday's swing high area, minor swing area that was tested twice during the earlier US session and the late US session over here. So with that, we got to see a breakout above 6620 to reinforce higher odds for it to actually see the next intermediate resistance coming in at 66.65. However, a breakdown below 65.20 will invalidate this short-term bearish outlook to see the continuation of this minor corrective decline heading towards the medium-term support area at 64.50, which confluence with the medium-term ascending channel support from the low of 26th of October, and as well as the upward sloping 50-day moving average, all confluencing at 64.50 level. Okay, so still maintaining that short-term bullish outlook on the Aussie dollar, 65.20 short-term pivotal support, upside potential upside trigger level 66.20. Okay, now that pretty much sum up for the FX market. So overall, you see the FX market over here is that yes, despite the dollar rebound on Friday, but dollar strength still remains on resistance. Okay, moving on to the broad-based stock indices. So let us start with the, okay, give me a minute, where is the markets? Okay, let us start with the Asia indices first. So for Asia indices, the Hong Kong 33 going to remain weak, and it plummeted below our support level that we highlighted on last Friday. First support level 6,100, followed by 5,800. So now it's inching down towards 5,800, which correspond to the lower boundary of this short-term minor descending channel that is in place since the high of 23rd of November this year. So for this, today we will have a tightened key short-term pivotal resistance for today, 6,300, which correspond to today's the current opening level in Asia session for today, and also close to the lower limit of this minor descending channel. So as long as this 16,300 tightened key short-term pivotal resistance is not surpassed to the upside, potentially the Hong Kong 33 may face further downside pressure towards 15,800. A break below 15,800 potentially expose the next intermediate support level at 15,500 level. However, at hourly close above 6,300 will actually negate this bullish tone to potentially see a minor counter trend rebound 6,500, followed by a break above 16,500. Sees the next intermediate resistance to come in at 16,890. So that's the Hong Kong 33 index. German 30. So German 30 last Friday we have a bullish bias heading towards 6,780/6,850 level, almost mid. So with that, we also start to see the hourly RSI start to flash out a bearish divergence signal. Price action on the German 30 shipping higher high, but the RSI now shipping lower high at the overbought level. So indicating to us that the uptrend the push up from 28th of November low all the way up to last Friday high, the upside momentum is losing strength, which the German 30 could be potentially red for at least a minor pullback at this juncture. So with that, we will be using 6,910 as my key short-term pivotal resistance for today. Potentially, the German 30 may see a minor pullback, with the first resistance to watch out for at 16,590, a break below it exposes 16,440, which confluence with the medium-term ascending channel support right now from that is in play right now from the low of 27th of October, and as well as this minor congestion area for 1st of December to 5th of December. So i.e. Flipping to a bearish bias for today on the German 30 index as long as 16,910 level, short-term pivotal resistance is not surpassed. But what if this level surpassed on the upside with the hourly close above 16,910, then this bullish impulsive structure may resume to see the next intermediate resistance coming in at 17,100. So that's the outlook for the German 30. Okay, US stock indices. So US stock indices, the US Wall Street 30 going to still trade within a zone, a minor range range configuration that is in place since 1st of December high. That means the previous Friday, means 2 Fridays ago. All right. So all in all, what we could see over here is that as long as 16,300 short-term pivotal resistance is not surpassed to upside, potentially the US Wall Street 30 may retest the lower limit of this resistance zone, range resistance at 35,985/35,930. However, a break up at hourly close above 36,300, then this bullish impulsive wave structure may resume with the next intermediate resistance coming in at 36,555. Then moving on will be the Nasdaq 100. So over here, the Nasdaq 100 over here, what we could see over here at this point in time is that the hourly chart on the Nasdaq 100 also going to be trapped inside this range that is in place since 22nd of November at 16,160. So very interestingly, yes, price action going to push up, shipping a higher high on last Friday. Okay, a higher last Friday. But however, the RSI on the hourly RSI has started to shape a lower high after hitting the overbought level on last Friday. So this is a bearish divergence condition, indicating to us that the rebound on last Thursday to last Friday is losing strength. That means, i.e., potentially the Nasdaq 100 may start to see a pullback back towards the range lower limit, all right, over here. So with that, we'll be using the 6,160 as my key short-term pivotal resistance, no change for today. So still maintaining that short-term bearish outlook on the Nasdaq 100 to have that kind of a push down towards the lower limit of this minor range configuration, with the first support level coming in at this 15,780, then followed by 15,690. But however, if it have an hourly close above 16,160, then this impulsive structure may resume to see the next resistance coming in at 16,310. Above it exposes the all-time high range level at 16,590. So 16,590, if you look at it over here on the daily chart, is actually close to this all-time high area, swing high area of 22nd of November, confluence with 28th of December in the year of 2021. So that actually give me the next resistance at 16,590. Okay, so with that, that's pretty much sum up with the benchmark, global benchmark stock indices for today. So we do have continue to have the bearish outlook on the Hong Kong 33 index, flipping to a bearish outlook on the German 30, given the fact that the resistance has been met, where the hourly RSI has started to flash out a bearish divergence condition, and still maintaining that short-term bearish outlook on the Nasdaq 100 and the Wall Street 30 within its minor range configuration for now. Okay, now gold price, commodity. So for commodity over here, what we could see at this point in time for the gold price is that the spot gold started to actually inch much lower on last Friday, and it broke below the 2006 pivotal support that we highlighted as well to actually look out for the potential recovery scenario after its fresh all-time high that was made on last Monday, okay, at 2,149. And right now, it also managed to clear below the pierce below the 20-day moving average and as well as the ascending channel support from 6th of October low. So all in all, right, what we could see, the price action right now is actually exhibiting a high probability of the continuation of this minor corrective decline within its medium-term uptrend. The next support level to watch will be at 1955 level, which is confluence with the upward sloping 50-day moving average and the 200-day moving average as well, and as well as 2040 short-term pivotal resistance will be my resistance to watch out for today. So if this resistance is not broken on the upside, we will actually have a short-term bearish outlook on spot gold XAU/USD. Only an hourly close above 2040 will negate this short-term bearish outlook, with the next intermediate resistance to watch out for will be at 2067 next. All right, so that's the outlook for gold for now. With that, that pretty much okay. One more thing before we go is oil price. I forgot about oil price, so let's take a look at oil. Okay, so WTI oil, which is West Texas crude oil, we call it our platform. So on last Friday, right, we do have a short-term bullish outlook on oil price, looking out for this potential, we call it a rebound taking shape. So all in all, right, after that bullish divergence that was flashed out on Thursday, oil price going to inch much higher above our pivotal support level that we highlighted on last Friday, 67.55/67 figure. So with that, oil price going to inch upwards and heading now very close to our near-term resistance at 72.40, then followed by 74.36, which is the downward sloping 20-day moving average. So with that, hourly RSI also doesn't show any signs of a bullish exhaustion. So in fact, it starts to break above this 50 level mark over here. So indicating to us that there's some signs of continuation of this potential minor counter trend rebound scenario that is still in motion since last Friday low. So all in all, what I could do over here is that I will actually tighten the key short-term pivotal support for today at the confluence with the minor swing low of last Thursday and last Friday at 69.35. So 69.35 level will be my tighten key short-term pivotal support for today. Okay. Okay, for today. Okay, let me highlight. Okay, then this will be the next support level to watch. All right, so as long as 69.35 short-term tighten short-term pivotal support holds, potentially WTI crude oil may continue this minor counter trend rebound, with the resistance to watch will be at 72.40, above it 74.36. Hourly close below 69.35 then invalidates this short-term minor counter trend rebound scenario to expose again the next support zone level at 67.55/67 figure on West Texas oil. Okay, so with that, that pretty much sum up with our daily dose of market insights. So before we go, let's look at the economic calendar for today. What are the data to watch out for? So for today, it will be a pretty much quiet session throughout the European and the US session, as there's no release of any key economic data and as well as news flow. All right. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.